Hello, welcome to LCG's preview for the week ahead. I'm going to discuss the Federal Reserve interest rate decision, non-farm payrolls, and earnings from tech giants including Apple, Amazon, Microsoft, and Facebook. Before that, though, I'll run down the biggest events in the economic calendar where data is fairly concentrated into the back half of the week. So on Wednesday, it's Australia CPI, Germany CPI, US Q4 GDP, and the Federal Reserve interest rate decision. On Thursday is China PMI data, the RBA rate decision, and Eurozone Q4 GDP. And then on Friday, it's US non-farm payrolls and average hourly earnings, then the US ISM manufacturing PMI. Moving on to the top results to watch on the corporate calendar, Caterpillar reports Q4 earnings on Monday. 3M, AMD, eBay, and Apple report fourth quarter results on Tuesday. Banco Santander and Volvo have full-year earnings reports, whilst Siemens, Alibaba, Tesla, Facebook, and Microsoft offer up quarterly updates on Wednesday. Nokia and Unilever report full-year results, while BT, Royal Dutch Shell, and Amazon report Q4 earnings on Thursday. And then Deutsche Bank and Danske Bank release full-year numbers before Chevron and Exxon report fourth quarter earnings on Friday. So first consideration, and probably the major event that we'll be building up to in the first half of the week, is that Fed meeting. It's that time again. No change expected on rates this time around. One change that is rather different is that Jay Powell, the chairman, will be giving a press conference despite there being no new economic forecasts. So for 2019 and presumably moving forwards, there will be a press conference after every decision, unlike on previous occasions where it's always just been after the economic announcements have been made. So we're not expecting new forecasts this time around. So it's really going to be all about the statement and that press conference afterwards. We're expecting, well, the market at least is expecting an official dovish tilt from the Fed. So we had a fairly hawkish decision with no hint at reducing the pace of the reduction of the balance sheet in December. Since then, we've had some softer statements talking about being wary and watching the market, and also being wary of global factors and a weakening global environment, all suggesting that the Fed probably not going to go full pace on 4 rate hikes this year. So we're expecting to see something along those lines in the official statement. But the balancing act for Powell here is going to be balance the fact that actually US economic strength is very good, wage growth notably, versus the global weakness, especially we learned last week in the Eurozone and still to some degree China. That will be the balancing act for the Fed. The way he leans in the press conference will be whether it's on those global risk factors or on the healthier domestic environments, will probably determine how the dollar and stocks react to this. What may limit the reaction somewhat is that we do have non-farm payrolls later in the week. So FYI, the expectations there is for 160,000 jobs created. That's versus the blowout number of 312,000 created in November. Another blowout number probably would be good for the dollar. It's hard to see how it wouldn't be, but it's not quite so clear how the reaction stocks would be. We suspect that actually we could be back to a situation where good data is bad because there is a global slowdown taking place, or there's very much fears of it at the moment, and we're seeing some evidence of it, particularly in Europe. There is higher market volatility, particularly after that December sell-off. So that all adds, that's all downside risks to the market. But if these job numbers come out very strong again, that will put pressure on the Fed to raise rates even amid all that turmoil. And that's not the kind of Goldilocks environment that stock markets typically like to react to the strong data on. Moving on to the tech earnings, Apple is the big one now more than ever, really. That follows the warning the company gave prior to the release of these results, which pretty much said that it's expecting these numbers to not be as good as they've been in previous years, notably blaming China, the economic slowdown in China, Obviously, the trade war between the US and China probably hasn't helped demand for Apple products in China as well. In fact, in a few instances, some Apple products were blocked from being sold. We've got a few incidental facts. For example, Foxconn, the supplier, the major supplier of Apple products in China, cut 50,000 jobs, which is quite a shockingly large number. So obviously demand is lower for iPhones in China. On that front, if we do see a US-China deal come about, which isn't necessarily baked in, but people think it's still possible, you would imagine that Apple shares should be a beneficiary of that purely on the market sentiment side of things. The question is really whether the rest of the world will upgrade phones at the same pace outside of China, that is. They probably won't. There isn't as much difference between each iPhone model, so there's not as much justification for the upgrade. If that is the case, Apple need to make up the deficit through their service revenues. But one risk to their service revenues is that a lot of it's through this so-called Apple tax. Every time you buy an app or an ebook or something through the Apple device, Apple charges something anywhere up to 30%. Some of the big, more powerful platforms, particularly likes of Amazon, maybe Netflix and Spotify as well, are going to try and avoid paying those App Store fees, and that could be a big dent to the growth of those service revenues. Amazon, despite the December rout, up 30% year over year, so still doing exceedingly well. Got to say that the pretty solid business model overall, but they did give some weaker guidance for Q4 in the Q3 numbers, so there's going to be a slight revenues and profit slowdown, it looks like, year on year in Amazon. But so the question will be how it does versus expectations. Typically, they beat the expectations. If they don't, could be in for another rough ride. But still, much like we said with Microsoft, who incidentally are reporting this week, even though we talked about them last week, they've shifted their earnings back to this week. Probably the biggest risk is just the market overall. If we see another drop in the S&P 500, tech shares will probably fall further than others because of their high valuations. Facebook, a bit of a different beast altogether at the moment. Their privacy and security issues really still very prominent. If Facebook do actually implement some of these privacy policies, probably the net result is they're going to get less revenue per user. So that means slower growth. We'll be watching out for those monthly active users numbers. They've got a new tilt on it now. The new figures are for all the Facebook-owned platforms, including Instagram and WhatsApp and the rest of them. So not just the main platform. So there is still growth overall across their platforms. And I think Facebook acknowledging there that probably the main platform not going to be the major source of the growth moving forward. It will be those other apps that need to pick up the slack. Thank you very much for watching. Good luck with trading this week. And if you want to see these videos as soon as they're released, please follow LCG on YouTube and social media.